Hello and welcome to the Business Standard Morning Show. I'm Binu Sandhu. Let's take a look at the stories for the day. India is finally set to join the league of countries where people are enjoying high-speed 5G networks. The government has said the auction was a success and it added 1.5 trillion rupees to the exchequer. With the auction done and over with, let us explore how each player is placed and will the 5G rollout be a watershed moment for the telecom sector.
Seven days and over 40 rounds later, Reliance Industries Limited has emerged as the top bidder in India's first 5G spectrum auction. While 5G was the auction's centerpiece, the government had also offered 72.09 GHz of spectrum across 10 frequency bands for sale. At Rs 1.5 trillion, the total revenue figure is the highest amount earned since mobile auctions began in 2010. The quantum of spectrum on offer was also the highest, but the government was able to sell only around 35% of the spectrum on offer in value terms, given the total figure of Rs 4.3 trillion as per the base price. Communications Minister Ashwini Vaishnav said that based on the bids, the telcos have to shell out Rs 13,365 crore as their first installment in a few days. Shelling out more than double the amount that Bharti Airtel did, Reliance Jio emerged as the top bidder at Rs 88,078 crore for 24,740 MHz of spectrum. Apart from the 1800 MHz band and the 5G bands of 3.3 GHz and 26 GHz, this also includes the crucial 700 MHz band, which is considered critical for 5G. Jio was the only player that brought spectrum across bands that are considered critical for efficient 5G services globally. This is crucial because Jio is going in for an advanced standalone 5G network, unlike its rivals, who have opted for a non-standalone network. Airtel appeared more circumspect, buying 19,876 MHz of spectrum in various bands, including 5G, for Rs 43,084 crore. It kept away from the crucial 700 MHz band. Vodafone Idea spent far lower at only Rs 18,799 crore for 6,228 MHz of spectrum. The new entrant, Adani Enterprises, whose entry into the sector took many by surprise, spent just Rs 212 crore for bagging 400 MHz in the millimeter band in 6 circles, including Gujarat, Mumbai, Karnataka, Tamil Nadu, Rajasthan and Andhra Pradesh. Adani purchased these airwaves for setting up captive non-public networks across its airports and ports. So where does this leave the sector as a whole? Reliance Jio bought 10 MHz across all 22 circles in the 700 MHz band, which will give it a distinct advantage in 5G because of its huge coverage and requirements for fewer towers. It can cover the entire country with this band. According to Bank of America Securities, with regard to 5G rollout and market share gains, RIL is the best positioned player, followed by Airtel. The advantage of standalone 5G is that Jio would be able to offer true low latency applications. Meanwhile, it will be difficult for its peers to offer the same given the lack of spectrum. Overall, BofA Securities finds that all of this could help Jio poach high-end customers from its competitors.
Well, it's too soon to say that it will be a disruption because unlike 4G, 5G is much more niche. 5G is not a logical extension of 4G in that sense, right? 5G has new features. So yes, Reliance, having obtained 700 megahertz, can be expected to roll it out on a much wider scale. But time will tell how this plays out. It's clear that it is increasingly dominant in the market. But I think the market share of players like Airtel and even Vodafone is not insignificant. Even at number 3, I mean, Vodafone has roughly 20 crore customers. So I don't think that we are in for a walkover for one single company or that a duopoly is imminent. But yes, the dominance of Reliance Jio will actually will be much more than it was already.
According to Nomura, a 700 MHz band could also potentially give Jio an advantage in terms of network quality, especially indoors. Airtel will likely come under pressure to have a network similar to Jio if the latter is able to create a significant differentiation in network quality for 5G. According to BofA Securities, this raises the probability of Airtel acquiring the 700 MHz band in the next auction, where the pricing is likely to be similar to that at the recently concluded one. All of this could translate to capex investments being higher for Airtel. Overall, 5G related investments are likely to remain high for a couple of years. Meanwhile, Vodafone Idea has restricted its 5G plans to priority areas. This was evidenced by the fact that it only acquired 5G spectrum in 16-17 priority circles. Also, given significant delays in fundraising, capital expenditure constraints, existing gaps in 4G coverage, and just 12 to 15% share of spectrum in the 5G bands, Nomura projects that Vodafone Idea's 5G rollout would likely lag behind that of its peers. This could lead to further accelerated market share gains for Jio and Airtel. So will the telecom sector see another disruption led by Jio like the one it saw with its entry into the business?
I can say that the sector is not in for another disruption. So I think the sector is now forward-looking. The sector is now looking at consolidating. The sector is now looking at providing better quality services to customers, better innovation. The pricing to start with may remain the same, maybe even marginally discounted to 4G so that to lure more and more customers on the 5G network. And when I say pricing, the bundles could certainly change because 5G globally has also shown that the consumption of data goes up. So the data that we will consume will be much more. Now that could lead to a higher ARPU for the operators, even though we have some of the unlimited data packs or data packs which are not crossing the current limits, but we may see that happening. I think the other thing that we may see with 5G happening is, home broadband. India just has about 10% penetration when it comes to home broadband or fiber to home. And that's what I mean by home broadband. I think 5G with the small cell architecture, the last mile problem could get solved. And whilst we still need a lot of intracity fiber, but the last mile issues would get solved. And we may see a faster home broadband rollout as well. And that could be an opportunity. And we've seen.
In all likelihood, we may not see any disruption, and there may not be any price wars either. Nomura says that Indian telcos have refrained from charging a premium for 4G plans when compared to 2G and 3G ones. However, with higher speeds and the initial uptake coming from premium customers, it sees a potential for telcos to charge a premium for 5G when compared to 4G. In fact, 5G premiums might provide the next leg of average revenue per user uptake for Indian telcos.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
5G network will indeed change the way we use the internet. It may also transform the telecom sector as a whole. Similarly, one more sector is all set for a dramatic transformation. On 29th July, Prime Minister Narendra Modi launched India's first bullion exchange at Gujarat's Gift City. Experts are of the view that the exchange makes the gold price setting mechanism transparent. With agencies charging different margins, transparency was so far missing here. It will also bring down the price of the yellow metal. Let us find out more about this exchange and what else it will do.
India is the world's second biggest consumer and importer of gold, buying about 800 to 850 tons per annum. The country accounts for 25% of the world's gold demand, but so far, India has not been a global price setter for the yellow metal. The recent launch of the India International Bullion Exchange, or IIBX, in Gujarat's Gift City is a step in that direction. India's first global bullion exchange, the IIBX, will facilitate efficient price discovery and ensure standardization, quality assurance, and sourcing integrity. Until now, only certain banks and nominated agencies were allowed by the Reserve Bank of India to import gold and sell it to dealers and jewelers. The bullion exchange will allow qualified jewelers to directly import gold. Qualified jewelers with a net worth of 25 crore rupees and 95% of revenue from jewelry and NRIs with $500,000 net worth can trade in the exchange, provided they want to take delivery. The biggest gold consumer, China, runs such a bourse where all domestic production and imported gold have to be bought and sold. Established along the lines of Shanghai Gold Exchange and Borsa Istanbul, India's bullion exchange is aimed at making the country a key regional hub for bullion flows. It has already onboarded over 60 jewelers and many more are in the pipeline. Ashok Gautam, the CEO of the Bullion Exchange, said that silver trading will be allowed on the exchange in the future. In the early stage, 1 kg gold of 995 purity and 100 gram gold of 999 purity will be traded with a settlement period of T+0. The settlement period will be later extended to T+2 days. The trade will be in the form of bullion depository receipts denominated in dollars. The exchange has also roped in 3 companies to provide vault services.
The government is trying to give an advantage to the bullion dealers and to the jewelers that you can now import directly and you need not go to banks to buy the gold. The advantage of this would be that the government wants a price discovery as we consume about 30% of the gold in the country. So if we are able to discover the prices, okay, and if the gold becomes cheaper even by $1 or $1.5 or $2, eventually the entire benefits would be passed on to the consumer itself. We were dependent on price which were declared by the other countries. So basically, it is not going to increase the import at all as far as India is concerned. But like in Shanghai Gold Exchange, in Shanghai also, China also has a consumption of about 1100 tons to 1200 tons. Almost we are number 2 with 1000 tons or so. In China, this volume in the international exchange is 79,000 tons. So we are also looking at that volume. And what we are basically looking at, India becoming the major hub for gold vaulting and storage facility. We can discover the price, that is number 1. Secondly, the cost of vaulting the goods in our country is cheapest if you compare it with the other countries of the world. So that is why we are looking at a larger volume. So also in the Asian market, India is considered to be the safest country, safe, secular and democratic country. So people would definitely, the foreign supplier would store material here and would like to do business from India only. So that is the biggest advantage.
Apart from enabling price transparency for gold, the India International Bullion Exchange will also help in bringing foreign traders to Indian shores.
यार
मत पूछ यार,
फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता? अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Meanwhile, investors are again looking at striking gold as foreign investors return to equity markets. Analysts are eyeing select sectors that are expected to garner the most attention from global buyers. Our next report takes a look at these topics.
Foreign investors have accelerated buying of domestic shares recently. They picked up nearly 5,000 crore rupees worth of equities in July, breaking their selling spree of 9 months. Analysts, however, remain cautious about the trend as the global backdrop of rising inflation and interest rates remain unchanged.
They have just about reduced their selling intensity and maybe purchased for a few days. This is not any indication that FIIs are likely to be back in the market in a hurry. The dollar index is also elevated. All these signs point towards outflows, not so much inflows.
As per data compiled by Yes Securities, IT, metals and financials were the top pockets that were dumped by FIIs between April to June this fiscal. On the other hand, oil and gas, FMCG, automobile and capital goods saw increased interest with upped stakes during this period. Moreover, during the first 2 weeks of July, some additional sectors bought by FIIs included construction, healthcare, media and entertainment and power, according to NSDL data. Overall, analysts are particularly bullish on IT and banks, among others.
FPIs have traditionally been very heavily weighted towards financials, considering that financials almost enjoy a weightage of anywhere between 30 to 35% in our indices and have borne the brunt of the selling over the last year or so. I think as the FPI selling moderates, we are already seeing financials show the strength. And I think among the sectors that should benefit from moderation of FPI selling it is the financials, which would be at the top, followed by IT.
VK Vijay Kumar of Geojit Financial Services, meanwhile, is upbeat on the auto and capital goods sectors. According to the analyst, easing chip shortage crisis and robust demand will aid the auto segment, particularly passenger and commercial vehicles, while impressive credit growth and green shoots of capital expenditure lend support to capital goods. Apart from foreign fund flows, stock-specific action will continue to sway the markets today. Vodafone Idea, Indigo, Lupin, Adani Power and Gujarat Gas are among key stocks that will be on investors' radar ahead of their Q1 earnings. Besides, the monetary policy meeting of the RBI will also begin today.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and reporting with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
In the mid-2000s, several infrastructure companies saw a period of robust growth and their shares shot up thanks to easily available credit. But as the loans piled up, public sector banks and the over-leveraged companies found themselves in a tight spot. It was called the twin balance sheet problem. Watch our next report to know more.
In February 2016, public sector banks started coming out with financial results for the December quarter, and the numbers were enough to send the stock markets into a tizzy. Their non-performing assets, or NPA, had soared dramatically to an extent that provisioning had overwhelmed operating earnings. Their net income had plunged deeply into the red. According to the 2017-18 economic survey, investors dumped the stocks of PSU, bringing their prices to such a low level that at one point, HDFC was valued as much as 24 public sector banks put together. A twin balance sheet is a scenario where banks are under severe stress and the corporates are over-leveraged to the extent that they cannot repay their loans. During a boom period, the economic growth is robust. Corporates are encouraged to invest and expand aggressively. The economic survey of 2017 and 18 Put it simply, a twin balance sheet problem follows a standard path. Their companies expand during a boom, leaving them with obligations that they cannot repay. So they default on their debts, leaving bank balance sheets impaired as well. Something similar happened during the mid-2000s. The Indian economy was booming, where GDP annual growth hovered around 9 to 10%. With corporate profitability at its highest, India Inc. launched massive projects worth lakhs of crores and were riding on huge amounts of debt, mostly financed by banks. By 2007 and 8, the investment to GDP ratio reached almost 38%, and the amount of non-food bank credit doubled from 2004 and 5 to 2008 and 9. However, following the global financial crisis, growth and revenue projections fell, and finance cost went up due to higher interest rates, resulting in stress on the books of both corporates and banks. The RBI had to step in to control the damage to the economy. But the country's finances are in good condition now. Public sector banks recorded an 81% year-on-year rise in net profit in the last quarter on higher net interest incomes and reduction in provisions for bad loans. A Business Standard analysis showed
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Former Chief Economic Advisor Arvind Subramanian and IMF's former India head Josh Fellman had come out with a paper in January this year claiming that the country is staring at the 4 balance sheet challenge. This included banks, infrastructure companies, NBFCs, and real estate companies. But not everyone agreed with them. That's all for today. For more news and analysis, please log into our website www.business-standard.com. And we'll also be back tomorrow morning with more. Stay tuned and thank you for watching.
If you liked this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.